Welcome back. In my video I posted yesterday, I talked about how Redfin shared that home prices overall, based on the US median home sold price, reached an all-time record high. And of course, rates and housing payments have been increasing as well. And that was this report right here. I'll provide a link in the video description below if you guys missed that video. But in today's video, I want to talk about some leading indications of home buying demand so we can gauge which direction we're headed, because based on lagging data, based on home sold prices, we're at all-time record highs. So I have a lot to share in today's video. This video may be a little bit longer. I don't script my videos, but I have a lot of reports that are all leading indications of home buying demand that I want to share with you guys. So hope you guys get a lot of value in today's video. And thank you so much for joining me. So the first report I want to cover in today's video is based on NAR's, or the National Association of Realtors, pending home sale index. And that was posted on April 25th. This, by the way, is according to investing.com. The street's forecast for the National Association of Realtors pending home sale index was an increase of 0.3%. That's what they were expecting, but it came in way above that at 3.4%. This is also about double the percent increase we saw in the previous month. This, of course, is a measure of contracts being signed between buyers and sellers of existing houses. Therefore, this is a leading indication of closed home sales in the next couple of months. And here's that report from NAR, just posted today, which is on April 25th. The pending home sale index, or their PHSI, is a forward-looking indicator, as I mentioned, that increased to 78.2 in March. Year over year, pending transactions were up by only 0.1%. However, it did increase by 3.4% compared to February. According to Lawrence Yoon, who's NAR's chief economist, he stated the following: March's pending home sale index at 78.2 marks the best performance in a year, but still remains in a fairly narrow range over the last 12 months, without a measurable breakout. Meaningful gains will only occur with declining mortgage rates and rising inventory. I don't often agree with him, but I absolutely agree with him regarding that, because I would imagine, just kind of think of an environment in which we have 5% rates. If rates were to decrease from 7.5, the best rates you can get on average today, down to 5%, what do you guys think will happen with home buying demand? If rates were to decrease big time and we saw more houses for sale, that will likely cause their index of contract being signed to rise as well. In regards to pending sales, every market's different, right? So you look at the four biggest US regions, and they varied quite a bit. So the only region that posted a decrease compared to February was actually in the Midwest, falling by 4.3%. In contrast, the West surged by 6.8%, and the South increased by 7%. The Northeast rose by 2.7%. Here's also a snapshot looking at their index, which I love this because it is seasonally adjusted. It's also annualized as well, making it very easy to compare month over month data. Because the index here is adjusted due to seasonality. So overall, compared to last month, up by 3.4, but still relatively flat from 1 year ago. And the index at 78.2 is higher compared to the all-time record lows, excluding the onset of COVID at 72.8 back in August last year. Additionally, when you compare the index right now compared to the year as a whole in 2021, when the index overall for the year was at 115.2, that means that right now we're down by about 32% from 2021. I mentioned that because we did see this increase from last month, but overall we're still at relatively low levels, especially compared to the craziness we saw in 2021. Let's look really quickly here at the year-over-year changes, and I'll share some stats regarding my own analysis, other data, to share how these trends compare to years past, going back to 2010. So again, on a month-to-month basis, the only region that decreased was in the Midwest, but year over year, it fell in the Northeast down by 0.3%. The South was down by 1.5%. The West posted the biggest increase, up by 3.6%. All right, let's have a look at my own analysis of their data. I pulled these two columns from the National Association of Realtors website about 2 years ago now, or a year and a half, and just keep on adding this or adding on to this each and every month. So for March, that index is at 78.2. Looking at historical trends, this is the highest levels going back to February 2023. It increased by 0.1% year over year, and that only marks the second time in the last 34 months in which their index increased on a year-over-year basis. And this month barely squeaked out a gain of 0.1%. So we basically have had, more or less 3 years in which pending home sales have been decreasing on a year-over-year basis. Also, when comparing what happened last year this time, their index decreased by 24%. Now it's up by 0.1%. So quite the turnaround compared to the huge fallout we saw in the last half of 2022 through much of 2023. However, when looking at historical averages, and here's the average March year-over-year change going back to 2010, based on my nerdy formula there, is a gain of 0.4%, whereas this year it only increased by 0.1%. All right, let's also talk about the month-to-month change as well. That increased by 3.4. That's better than the 3.9% decrease we saw back in March of 2023. And on top of that, it's actually higher than the long-run average as well, because the long-run average is a decrease of 1% from February to March each and every year. Now it's up by 3.4%. Also, I add this as well. When looking at their index this March compared to March of 2019, obviously pre-pandemic era, we're down by 28%. And from March of 2018, down by 27%. So even though we're up slightly from a year ago and up from last month, we're still way below pre-pandemic norms. In addition, we kind of have this tale of two different markets, because this index is based on existing houses, but looking at brand new home construction, it's actually a little bit different. So pendings of existing houses are counted the same way, more or less, as sales of brand new home construction, because the U.S. Census Bureau defines a new home sale as when a home builder accepts an offer from a home buyer or gets a deposit for a brand new house. That could be a dirt lot, a home under construction, or a completed sale or completed house. So this index from NAR can be more or less compared to new home sales of brand new home construction, because that's based on a contract being signed. They're both measured that way. Also in March, pending sales rose by 0.1% year over year for existing houses. Compare that to brand new home construction, it increased by 8.3%. Also, pending sales for existing houses increased by 3.4% from February to March this year, yet new home construction sales surged by 8.8% during the same time period. As I mentioned, home builders are still being able to drive sales by offering incentives. So for example, money towards buyers' closing costs, and of course, a lower than market mortgage rate, which is enticing home buyers to place offers on brand new houses. I also want to share a mortgage rate update with you guys as well, because again, average 30-year fixed rate mortgage rates increased to a 5-month high on Thursday, April 25th, which is the time of filming this video. I found this really good chart showing the relationship to stocks, or the stock market in general, and also the 10-year treasury yield, because once GDP and PCE data was released this morning, stocks absolutely tanked. When I woke up this morning, I think it was down by over 600 points a Dow, and the 10-year was up to over 4.7%. And that was because GDP came in slower than expectations, and PCE, which is a measure of inflation, came in hotter than expected. And that's this right here. This is on investing.com. GDP for Q1 this year came in at 1.6%. The forecast was a gain of 2.5. The previous reading which was in Q4 last year, up by 3.4%. So overall, goods and services produced by the United States are slowing in Q1 this year. On top of that, core PCE, which is a personal consumption expenditure, or the PCE report, that's a measure of goods and services that are consumed by Americans, excluding food and energy. That surged by 3.7%. The forecast was an increase of 3.4%. And what's really bad here as well, the previous reading was a gain of 2%. Now we're at 3.7%. So the odds of a future rate cut by the Fed is getting less and less likely. The odds, like last time I saw, according to the CME Fed Watch tool, a really good tool if you want to see the odds of future rate cuts by the Fed, is only calling for 1 to 2 rate cuts this year, and potentially not to see a rate cut until September. But there is a higher chance, or a increasing likelihood, we're going to see no rate cuts this year at all. So absolutely wild. I mean, we're not going to see any rate cuts anytime soon, because we're seeing that inflation data is actually coming in hotter than expected. It's moving in the opposite direction. So that is going to keep it this an environment for higher than longer for mortgage rates, and of course, interest rates you pay for HELOC, credit cards, etc. So speaking of rates, as of today on April 25th, for people with great credit, by the way, the average 30-year fix, according to the Mortgage News Daily, is at 7.52%. That's a 13 basis point increase compared to yesterday. Jumbo is at 7.68%, and FHA and VA loans is around 7%. What's pretty fascinating as well is that about 1 week ago, the difference between this year and last year was only 73 basis points. Now it's about 1 percentage point. The average at 7.52%. For a 30-year fix. 1 year ago, we're at 6.50%. On top of that, we surpassed the previous peak over the past couple of months that was set back in mid-April. So at 7.52%, this is the highest rates we've had going back to mid-November of 2023. So in other words, a 5-month high, which is making housing affordability an even bigger challenge, especially given the fact we have all-time record highs for home sold prices on a national level. All right, let's change gears slightly here. I have a lot more to share in today's video. All early signs of home buying demand, because again, when rates increase, that should decrease home buying demand as people decide to quit on buying a house, or they just get priced out of the market. So time will tell, and I'll keep you posted on that. So here's a report I found from the National Association of Realtors. This is for the month of March, just posted a couple of days ago, I believe. It says U.S. showings, these are real estate agents showing houses to their home buyers, that increased by 6% compared to March 2023. So we are seeing more real estate showings, which is makes sense to me given the fact we have, depending on which source you're looking at, but looking at Realtor.com and AltosResearch.com, we have approximately 30% more houses for sale on a national level from 1 year ago. Also, this is a report just posted a few days ago as well from the MBA regarding the measure of people submitting loan applications to buy houses. That's what they're called, their seasonally adjusted purchase index. When their index increases, that means that more people are applying for a home loan. When it decreases, that means that less people are, right? That decreased by 1% from 1 week ago, and was 15% lower than 12 months ago. According to Joel Kahn, who's the MBA's Vice President and Deputy Chief Economist, he said the following. Rates continued to move higher last week, reaching their highest level since late 2023 and putting a damper on application activity. The 30-year fixed rate increased for the third consecutive week to 7.24%, the highest since November of 2023. Purchase applications declined as homebuyers delayed their purchase decisions due to strained affordability and low supply. Again, historically speaking, going back to pre-COVID levels, we have a low supply, but we're still up by 10 to 30% year over year. The ARM share of activity increased to 7.6%. These are adjustable rate mortgages. So in general, when we see rates increase, we tend to see more applications for people doing an ARM because your payment on that is a lot less than a 30-year fix. But we're still at 7.6%. I think it was like the 24-month high was around 12%, and also the low was around 3%. So we're kind of right in the middle of that. We do not want to see this number skyrocket because I think back in 05, 06, I think around 80% were adjustable rate mortgages. So yeah, we're way below those levels. In any case, something I found to be interesting as well is that out of all the applications for home loans for purchases and refis, 30.8% were for refis, even though rates have been increasing so much. This tells me that people are doing a cash out refi and getting cash out of their houses because home prices have increased so much. But of course, because a lot of people have credit card debts and other debts that they need to take care of. All right, let's also change gears here a little bit as well, looking at Google searches for homes for sale. Because Google searches have been decreasing, the index right now is at 72. 1 year ago is at 92. This means that there's approximately 22% less interest for people searching for house for sale on Google. And lastly, let's have a look at Redfin's Home Buyer Demand Index. This is an index which measures the amount of home tours and other home buying services from Redfin agents. That fell 9% year over year. On top of that, it's at least a 3-year low during this time frame. So just taking a step back here, please leave me a comment below your thoughts regarding today's video. What the stats tell me in today's video is that yes, pending home sales did increase compared to 1 month ago, but will that continue given the rapid rise in mortgage rates? Let's actually just look really quickly at that because over the past month, this was an index for the month of March. So in April, let's have a look at what happened in April. In April, we started the month at 7.05%, and now we're at 7.5%. So rates have increased by approximately 45 basis points over the past few weeks. But back in the start of March, we were at around 7.08%. But by the time we hit March 8th, we're at 6.85%. And we're right in line with around 6.9% for much of the month. So I only mention that because pending sales increased by 3.4% month to month, but that was back when rates were a lot lower than the rates we're seeing today. So I would imagine we're going to see this continued environment in which we're seeing a low level of home buying demand and therefore a lack of contracts being signed. And that will imply that closed home sales in the next coming months will also remain low as well. In my opinion, regarding home prices, that really depends on inventory levels and mortgage rates. And looking further ahead until later this year, the unemployment rate as well. But that's my take. What's your biggest takeaway from today's video? Please like and subscribe, and we'll see you in the next video. Have an awesome day.